We are very fortunate at this point to have with us Mindy Lubber, who is the CEO and president of the sustainability nonprofit organization, Ceres. She leads an all-woman executive leadership team and more than 160 employees working to mobilize the most influential investors and companies to solve the world's greatest sustainability challenges. She's been at the helm since 2003, and under her leadership, the organization and its powerful networks and global collaborations have grown significantly in size and influence. In 2020, she was awarded the United Nations Champions of the Earth Entrepreneurial Vision Award, and in the same year was on Barron's list of the 100 most influential women in the US finance, and also in 2021. We have recently begun a collaboration with Ceres, and it seems we are very optimistic that this is an interesting direction to go, and we are very anxious to hear what Mindy has to say about the importance of the work of Ceres and the entire climate agenda. So without further ado, let me turn the floor over to you, Mindy.
Terrific. Thank you, Bob. And it's great to be here. I spent the morning with scientists, the national science organizations, and I realized as advocates, as lawyers, as some economists at Ceres, that the challenges we face really are about science and the economy, or at least the arguments that may prevail will be driven by science and economics. So this discussion couldn't be more real, it couldn't be more practical, it couldn't be more grounded in the reality of today. So thank you for having me, and I'm looking forward to our partnership work together. Ceres has spent the last 30 plus years working to integrate sustainability into capital markets, working with some of the world's largest investors and largest companies to do just that. With companies, we work with their boards, train their boards, help companies set goals on what good sustainability practice looks like, and assure and affirm that those goals are grounded in short, medium, and long-term efforts. We know in a world of climate risk, talking about what we're going to do in 2040 or 2050 is almost mythical. I mean, it's great, let's talk about it, but what we need are words and deeds moving forward, and we need the action to be now. We need goals at 2025, 2030, 2035. And that's what we try and do with the hundreds of publicly traded companies who are members, and with the 220 North American investors and 630 global investors with whom we work. We are nonpartisan, we're nonprofit, but we are advocates, and having the ability to work with academics who provide the data with a different level of respect, but data that we could use, data that is valid, that's economics driven, is a crucial part of what we do, and thus the engagement with the Institute. To be a little bit more specific, we work with companies on a number of things. We work to change their board practices. We do training of corporate boards. We work to change their literal goals on sustainability, from climate to water, to a number of other important values-driven issues. And we work with them to change their public policy positions. No longer do we believe a company could be seen as a leader on climate, yet supporting the Chamber of Commerce, who may be killing a particular climate bill. But we know that private sector leaders have a clear role. I'll come back to our public sector work, but private sector leaders driven by economics have to be part of this debate and have to be leading the debate. We also know that in our work with 600 plus investors globally, that they are looking at climate because of the economic impacts to their portfolio, because of the companies in their portfolio, and because what they believe needs to be done. So with the investors, we are working to change their portfolio mix, more money in renewables, less in fossil fuels. 610 of those investors have joined our Climate Action 100 initiative, where those 600 investors engage through our prioritization with 160 largest emitters to work with them to bring their emissions down. And frankly, when the investors run out of patience after several years of engagement, they often will even take the arguments and file shareholder resolutions. And again, as an economic imperative, not only as as boundary limits to our planet and to the humanity of this. So anyone who thinks climate is just an environmental issue, and I know that's no one in this audience, obviously is not thinking about the $60 trillion in assets under management that are looking at dealing with climate, or the leading Fortune 500 companies that are acting on climate. I would say in the last 5 years, we've seen exponential growth in private sector action, partially driven by values, partially driven by economics, partially driven by policy, but the change has been quite extraordinary, and I'll come back to it. But largely because they know climate risk is now, it's happening. It's no longer something that they could put off and say, well, in 10 years, we'll think about what to do, or let's just set goals for the year 2040. I will say again, 2040 goals, if they are not grounded in short, medium, and long-term metrics, if they are not transparent, they're not really goals. They're wishes on a star, but they're not what we need. And most of the private sector leaders, again, the Fortune 500, the largest investors, I would not say this is the case across all of our markets, but the climate crisis today, not tomorrow, not next week, not next Wednesday, is impacting our global economy, expected to impact it further in every part of our economy: energy production, infrastructure, agriculture, real estate, products, supply chains, food, as well as human health and labor productivity. So somehow ignoring this and thinking it is a science imperative that we will have the technology to fix over the next few years is not grounded in the reality of fact and science and economics. Every year now, literally every year now, floods, wildfires, droughts are unleashing billions of dollars in damage. We're no longer at hundreds of millions, but we are at billions of dollars in damage. And transition risks, those risks, including the impacts that changes in policy and regulation will bring, technology changes, consumer preferences, are having a major impact on our economic portfolios. They're causing stranded assets, curtailed operations, market uncertainty, and they're here. They are now, they are acting. So it is time for us to act, whether it's private sector or public sector, and I will tell you, we need both. We can't have one without the other, and we need to act. Our world leaders, they are facing a critical moment right now in mitigating the climate crisis and ensuring financial stability. It's estimated that at current rates, literally current rates of emissions growth, climate change could slash global GDP by 11 to 14% by 2050. And we can't fix it overnight. We have got to start now and making major changes at a pace and scale commensurate with the risk. In the US alone, several federal regulatory agencies, including the Federal Reserve, the SEC, and Treasury, all have agreed that climate risk is real, it is a growing financial threat to our financial system, and that it demands action. The United States is still trailing. Our nation is behind the curve compared to other countries. 8 countries around the globe already require climate disclosure aligned with the Task Force on Climate-Related Disclosure Recommendations and have started initiating scenario analysis. The UK is now requiring companies to submit net zero plans. How are they going to get to net zero, and what do those plans look like? Here in the United States, we do not even have the standardized climate disclosure that it would allow the market to identify companies and investors' risks and the opportunities from climate. Disclosure, it is just the start, but it is in fact the foundation that financial institutions need to assess their own exposure and to make smart and informed investment decisions. That's why we've spent the last 10 years working with the SEC to mandate the disclosure of climate risk. And I want to come back to that and talk about what we need to do literally at this moment in time. But let's first look at the banking sector. The banking sector in America is far more exposed to transition and physical climate risks than most banks and regulators have yet to account for. They may talk about it in general, but the practices haven't changed. It's widely understood that banks are exposed to both physical risks associated with asset damage and transition risks caused by the failure to prepare for the associated shifts away from fossil fuels. But the current view of those risks in the banking sector is simply incomplete, and action is moving slower than it needs to. A couple of years ago, I think it was in 2020, Ceres examined the climate risk exposure in just the syndicated loan portfolios of the largest US banks. What we found was that more than half of the bank lending is exposed to transition-related climate risk, equaling as much as $500 billion in transition risks for the largest banks. And just as critically, our analysis showed that exposure is far broader than just the most obvious energy-intensive sectors. It's impacting oil and gas, transportation, electric power, and many sectors beyond the most obvious. When looking at banks, we also examined the physical risk of those syndicated loan portfolios. The value at risk for direct and indirect exposure to 28 of the largest US banks from physical risks alone could amount to more than $250 billion over time, approaching literally 10% of their syndicated loan portfolios, even if they start taking adaptation measures. And banks that fail to prepare for the energy transition unquestionably are going to face far higher risks than what they're currently measuring. That's just the start of it. It's even more critical for community banks and credit unions, whose loan portfolios are often far more exposed due to their geographic and sectoral concentrations. You know, we've got to keep looking at this, but we really need to act on it. We're now finalizing a report addressing the implications of climate change for credit unions, looking at both transition and physical risks. The report will show us, we've got just about the final results, and it will be out shortly, that the risks and opportunities, while presenting recommendations for credit unions to measure and mitigate their impact, but the risks and opportunities are greater, and action by credit unions need to act and need to happen sooner rather than later. As the linchpin of the global economy, financial institutions have a key role to play in minimizing the worst impacts of the climate crisis. How banks respond to the climate risk, whether they do so individually or collectively, is critical. When banks are proactive and ambitious versus reactive or barely modest, it reflects how they measure and analyze their exposure to climate risk, how they're looking at managing their risk, and how they're acting on it. And I can say, I think you've probably talked about all morning, there is a lot of work to do in this sector if we're going to meet the aggressive emissions reduction goals of the Paris Agreement. And if we could even begin to think we'll drive greater ambition, transparency, and accountability across capital markets. One major step, and I promise to come back to it, and it certainly is on my mind, and hopefully it will be on your minds every day, every night. Well, maybe not every day, but a major step towards achieving the insight and driving ambition is mandatory climate risk disclosure. Other countries have it, we don't. It is barely the start. We're not talking about even bringing emissions down with this particular proposal. We're talking about a new draft SEC mandatory climate disclosure rule that would require US publicly traded companies to disclose how their businesses are assessing, how they're measuring, how they're managing climate financial risks, and what to do about it, which is why we need to support it. The rule, it's a draft rule, it's 507 or 8 pages. It is detailed, it is strong, it is well thought out and well crafted, It would finally allow investors, many of our members who have been calling for this kind of risk disclosure for a decade, this rule would allow investors and companies to better tackle climate-related financial risks across their investment portfolios, across their supply chains, and to seize the opportunities that come from acting on those risks. I want to urge you, I know this is an economics conference and not an advocacy conference, but urge you each individually, collectively, to submit a supportive comment to the SEC before the May 20th deadline. We want to make sure we're shaping, and not telling you what to say in those comments, but that this final rule is robust, it does the job, and it's able to withstand what I would tell you is enormous opposition that's already growing. It is a critical moment. We've worked hard to get to this moment. We've done a lot together. We've been advocating at Ceres for standardized mandatory corporate climate disclosure for decades. In 2010, the SEC issued guidance on this matter. I will tell you that was not effective. It needs a formal rule, and that's what we're seeing. We've got a draft rule, 2.5 weeks public. Now is the time to dig in. During the past 12 years, the global support of mandatory disclosure has grown dramatically. It has become clear that climate change is a systemic risk to the financial system. Last year, a number of our members, the largest number of investors ever, 733 investors with $52 trillion in assets under management, joined us in calling for mandatory corporate climate disclosure. And while investors wait for regulation to catch up, they're going to continue to push companies to produce stronger disclosures through direct engagement and through annual shareholder proposals. And because the transition to a net zero economy provides massive economic opportunities, we're estimating that the transition to a net zero economy will require somewhere around $4 trillion in annual clean energy investments. Financial opportunities could arise from the development of new products, new lines of business, access to new markets, and investments in climate resilience, new energy sources, new transportation sources, and the list goes on and on. And while more than hundreds of companies and investors have made net zero commitments, we need to make sure those hundreds turn into tens of thousands. And we must make sure that we go from clear commitments to words and to action, from words to deeds. We need short, medium, and long-term goals, not I'm going to commit to a net zero future by 2050. We need short-term goals at 2025, 2030, and 2035. Nobody expected the auto industry to say by 2035, all combustion engine vehicles will be stopped in coming off their assembly lines, and they'll all be electric vehicles. Those are the kinds of robust, clear changes we need to see happen. Through Climate Action 100+ and Ambition 2030 initiatives we're working on, we're focused on driving companies to deliver on their commitments through developing and publishing clear climate action transition plans. These transparent plans are built around specific strategies, projects, investments, and time-bound science-based short and medium-term goals that will hold the companies accountable to achieving their commitments. And on the investor side, along with our partners, we've mobilized hundreds of the largest asset managers and asset owners to make their own commitments to a net zero future, not only to demand that from the companies in their portfolio, and to do so sooner rather than later. Think about the changes we've seen in our world. 5 years ago, companies weren't setting net zero science-based commitments. Now we have thousands. 3 years ago, or even 2 years ago, asset managers and asset owners were not even considering setting net zero targets. Right now, the Net Zero Asset Managers Initiative, one that we launched with many of our European and Asian counterparts, launched merely, I'd say a year and a half ago, now includes 221 investors with a combined $57 trillion in assets. That's 221 investors who 2 years ago would not have thought about doing this. And the Paris-aligned investor initiative, which is asset owners, includes 51 asset owners with $2.9 trillion in assets. We are getting there. We are making progress in the private sector. It will need to be augmented by the public sector, but we're getting there. And to help investors achieve their net zero goals, we're working and have developed a clear framework for developing and publishing investor climate action plans, otherwise known as ICAPs, investor climate action plans. And as the US economy decarbonizes, it's also critical that financial institutions, investors, regulators, stock exchanges, rating agencies, and policymakers prioritize the needs of our communities most overburdened by climate change, and in their process prioritize addressing environmental injustices. It includes pushing for and supporting state and federal initiatives, things like Justice 40, a White House coordinated effort to advance environmental justice and spur economic opportunity for disadvantaged communities. We've got to harness the power of private sector stakeholders. There's no doubt that we can't expect the leaders, the top 100, the top 500 to do it all. We do need policy. We need regulatory change. We know that the Biden administration has given a directive through Janet Yellen, the head of the Treasury, not the head of the EPA, that all federal financial regulators look at climate risk and figure out how deep is that risk and how to act on it. 2 years ago, the Federal Reserve, the Commodities Futures Trading Commission, and 8 other federal regulators were not even talking about climate risk. Now it's on their agenda, and the regulators have an obligation to look at it and act on it. And the Congress, in the next 12 days, may very well pass one of the most important pieces of climate-related legislation. They may not, we may never see it, but with enough support, the Build Back Better bill, which has morphed into bills with 10 different names, but which provide the greatest tax incentives, are ready to move forward. We've got to make sure that bill is written carefully, that it's not only getting rid of limitations, but that it really does provide the right incentives for renewables, not the right incentives for fossil fuels. But without the public sector, we can't get to the depth and the breadth that we need. We also need a price on carbon. For you all who are thinking about economics, capital markets move and they work well when they're honest pricing signals. Right now, our pricing signals for carbon pollution in most of the US and in most parts of the world are dishonest market signals. Right now, we charge 0 for carbon emissions. Right now, there's small pockets where we're trying to do it, but when something is free, what happens? We get more of it. So we've got to put a price on carbon, a legitimate price on carbon that allow capital markets to create and to work properly. So the bottom line is extraordinary progress, and we shouldn't lose sight of it in policy, in the regulatory front, and in the private sector. Extraordinary progress, but it is nowhere near the pace or the scale that we need to be to act on climate. We've got a lot of work to do in both the private and the public sectors. We need your help. We need good data. We're grateful for the research and modeling that Robert Engel, Richard Berner, and everyone here today are doing to look at and address the financial risk of climate change and how it's impacting our investment portfolios and our economy. We will move at a faster pace, but let's hope we can do that sooner rather than later. This is a problem that doesn't allow for slow-moving progress. It demands fast-moving progress now. And I'm hopeful that your data will help be the engine that drives us forward at a pace and at a scale that will actually make a difference. We're on our way. There was lots of good news, but the challenges are quite real. Thank you so much for all that you're doing and for the thoughtful research that you're building that I believe will have a profound impact, not only theoretically, but on the ground and on the ground fairly immediately. Great to be here with you today.
Well, thank you so much, Mindy. That's both informative and inspiring. And you've set a tough agenda for us all, and we're looking forward to good action coming from this.